I'm attorney Kelly Longtin from Kelly Longtin Law, where my firm focuses solely on estate planning, wills, trusts, powers of attorney, probate, and trust administration. So today in this video, I'm going to talk to you about handling S corporation interests in estate planning by electing small business trusts, and we're also going to discuss qualified subchapter S trusts. So one of the many challenges of owning a small business is determining the appropriate tax classification of the business. Now, when an individual owns a business entity that is classified either entirely or partially as an S corporation, it is important for you to seek guidance of an experienced estate planning attorney or tax advisor when planning for death. Now, depending on your estate planning goals, the advice provided by these professionals may be very different from the advice given to another business owner. So, for example, upon your death, do you intend to pass on your business as an ongoing business entity that will produce income for your spouse or another loved one? Is it important that the business continues to operate for years after your death to provide employment for your employees? Or would you prefer to sell the company to the other owners in exchange for cash, which can easily be distributed among your beneficiaries? Alternatively, do you intend to simply have the business shut down and have all of the assets sold? And is it important that your beneficiaries be protected from lawsuits, divorce, or bankruptcy once they do receive this inheritance? And as you can see, there's various scenarios that should be considered by a business owner when it comes to estate planning with a viable business. And because of certain federal laws, your estate planning must carefully address a business that is taxed as an S corporation. So let's begin by talking about what is an S corporation. The Internal Revenue Service describes S corporations as corporations that elect to pass corporate income, losses, deductions, and credits through to their shareholders for federal tax purposes. This election is allowed under Section 1362 of Subchapter S of the Internal Revenue Code, which is where S corporations actually get their name. Unlike a C corporation, which is first taxed on profits when earned and then taxed again to the shareholders when those profits are distributed, an S corporation offers the tax advantage of being able to pass income to the shareholders without first being taxed at the corporate level. The shareholders report their share of the S corporation's profits and losses on their individual tax returns and are assessed tax at their individual income tax rates. So under the Internal Revenue Code, an entity must meet the following criteria to qualify for taxation as an S corporation. First, it has to be incorporated within the United States. Second, it only has one class of stock. It does not have more than 100 shareholders. And the entity's shareholders are individuals, specific types of trusts and estates, or certain tax-exempt organizations. Partnerships, certain corporations, and non-resident aliens cannot be shareholders of an S corporation. Now, it is not one of those types of corporations ineligible for S corporation taxation, such as financial institutions, insurance companies, and domestic international sales companies. Let's talk about the types of trusts that can own stock in an S corporation. So there's specific types of trusts that may be shareholders of an S corporation. And the three most common types of trusts used to hold S corporation stock or membership interests are a Grantor Trust, a qualified subchapter S trust, and an electing small business trust. So let's talk about the Grantor Trust. In general, a Grantor Trust is a trust in which the grantor, or also called like a trust maker, retains certain powers over the trust, which causes the trust income to be taxable to the grantor. The commonly used revocable living trust is one type of Grantor Trust. Because of some of the disadvantages of qualified subchapter S trust and an electing small business trust, a grantor trust is often the preferred type of trust for owning an S corporation. However, grantor trust, also sometimes called testamentary trust, may generally hold S corporation stock for only 2 years after the death of the grantor, at which point the trust must either qualify as a qualified subchapter S trust or an electing small business trust, or distribute the stock to an eligible shareholder. Otherwise, the corporation's S election will terminate. So let's talk about a qualified subchapter S trust. So we'll abbreviate it to a QSST trust. A trust may qualify as a QSST trust if it meets several criteria. One is the trust has only one current beneficiary who is a U.S. citizen or resident. Secondly, all trust income is distributed to that sole beneficiary. Another is that the income beneficiary files an election with the IRS. Now, a QSST may work well in many circumstances. However, its requirements can also be unfavorable in certain situations. For example, the requirement that there is only one current beneficiary means that all of the beneficiary's children cannot also be beneficiaries of the trust. In addition, the requirement that all income is distributed to the beneficiary means that the income must be distributed regardless of the beneficiary's needs, potential taxable estate, or troubling behavior. Further, that distributed income would be exposed to the beneficiary's creditors, lawsuits, and divorcing spouse. Now, some practitioners create multiple trusts to isolate subchapter S stock in a trust that meets the criteria and allow other assets to be held in the trust with different terms. Let's talk about an electing small business trust, an ESBT. In general, a trust may qualify as an electing small business trust if it meets this following criteria. First, the trustee of the trust files an election with the IRS within a certain time frame. Second, the beneficiaries of the trust are all permissible beneficiaries under the Internal Revenue Code. Advantages of an ESBT are that they're not subject to the single beneficiary and mandatory distribution requirements of a QSST. In addition, because of certain phase-out deduction limitations that apply to individuals but do not apply to an electing small business trust, holding S corporation stock in an ESBT could result in income tax savings. However, the general rule is that all of an ESBT's income is taxed at the highest federal income tax rate. So if not all trust beneficiaries are in the highest tax bracket themselves, the overall tax could be higher when using an electing small business trust to hold S corporation stock. If the trust beneficiaries are not in the highest income tax bracket, some practitioners use careful drafting to cause the beneficiaries to be treated as grantors or owners under the Internal Revenue Code, which takes precedence over the regulations governing an electing small business trust income taxation. Now, when dealing with S corporation stock, it is really essential to follow the S corporation requirements to ensure that the corporation's S election does not terminate and result in what could be disastrous tax consequences. If you currently own shares of stock in a business being taxed as an S corporation, then call us to start forming a plan about what will happen to your business when you pass away. I believe that your family and your loved ones and your employees will definitely thank you for looking ahead to make sure that you pass on this interest appropriately. So I hope you found this beneficial. I want to thank you for watching. I'm attorney Kelly Longtin from Kelly Longtin Law.